Welcome to Inside Hawaii Real Estate. Hawaii real estate is such an interesting topic. Everybody wants to know how's the market. Our market here in Hawaii is definitely different from anywhere else in the US. And our entire show is about walking through real estate topics that we as realtors find fascinating to take you on a journey together with us to go inside Hawaii real estate. And I want to introduce you to my co-host, Will Tanaka. So Will is a full-time realtor together with me, but you know what's unique? He's also a licensed attorney and used to run a national title and escrow company. And together, he and I help buyers and sellers of real estate. Hi, Will. How you doing?
Hey, Leonie. To everyone, Leonie Lam is my wife, business partner, and co-host. She is a broker, a 20-year veteran of the Hawaii real estate industry, and a former executive of two of Hawaii's largest brokerages. And we are a husband and wife real estate team, so always an adventure, always having fun. And today, we're very honored to have a special guest, Brad Konishi CPA. Brad is a CEO and president of HARPTA Help LLC. So when you think about HARPTA, capital gains taxes, Brad's the man. And today, we're going to dig deeper into the world of capital gains taxes in Hawaii real estate transactions. So welcome, Brad.
Hey, thanks so much for having me, Will and Leonie. I really enjoyed this. I enjoyed my time last time, so I'll be happy to talk about whatever you want to talk about. I guess this time we're going to talk about capital gains.
Thank you so much, Brad, for being our guest today. And, I remember you from like over 20 years ago when I first got into real estate. And I remember calling you and I was like, hey, Brad, and I had questions regarding capital gains taxes, and you went through it and walked me through it so I could understand. I was brand new in the business. It was my personal situation. And you were so just generous with your time and kind. And I'm just so appreciative of that. And so as we get into this, what are capital gains taxes and why does it matter?
Okay, that's a great question because of course, whenever somebody has real estate, one of the biggest concerns they have is if I sell this, how much am I going to be taxed, right? So, one of the first things that's important to understand is that taxes are assessed in different ways, and there's something called long-term capital gains tax for short-term capital gains tax. And maybe if Eric could put up the graphic that I have, the long-term capital gains tax is for any asset that you've owned for over a year, and then now you're selling and it has gains. Whereas short-term is any kind of asset that you've held for less than a year. And when you hold an asset for less than a year, what happens is rather than the more preferable long-term capital gains tax rates, the seller usually has to pay what's called the ordinary income tax rate. And the ordinary income tax rate tends to be higher. The top ordinary income tax rate is 11% for the state of Hawaii and 37% for federal purposes. But capital gains tax is 20% maximum for federal purposes and 7.25%, for state purposes. So yeah, big difference between capital gains and ordinary income.
Okay, so Brad, when we're talking about capital gains taxes, is that just for investors or, let's say that someone owns just one home that they live in, it's their personal residence. Yeah. And, they held it for, it's been their family now, they might need to upgrade. So they're deciding to sell. Should they be worried about capital gains taxes if it's their only, principal residence?
Well, that's a great question, Will. And I guess to answer that, should they be worried about capital gains tax? I guess they should at least investigate whether they're going to be it's something that's going to apply to their transaction. But before I start getting deeper into the actual capital gains tax breaks that homeowners have, let me first go over some of the basics of capital gains and loss, which is, I think, really important to understand where it is. We have to have a foundation that we start from in order to, jump on top of that. So the basics of the gain or loss, when you're looking at whether you have a gain or a loss on your sale, two really important numbers that you need to know. The first number is something called your net selling price. And your net selling price, generally speaking, is whatever your gross sales price is, less certain expenses like commissions, escrow fees, title insurance. So that's one. That's the net selling price. But then there's something called the adjusted basis. And the adjusted basis is a second number that you need to worry about. Usually it's your purchase price, and I'm going to go into that in just a second. Usually it starts off with your purchase price. You can add to it with improvements. And then, of course, if this was a rental property, you depreciate it, and that depreciation lowers your basis. So there are some additions and subtractions that come to your basis during your period of ownership. And so if you have a situation where your net selling price is greater than your adjusted basis, you have a gain. And if you have a situation where it's opposite, where your adjusted basis is more than your net selling price, and that's the graphic, then you have a situation where you have a loss, where your adjusted basis is more than your net selling price. So, those are essentially it. But, it's important to understand the concept of basis. And I'm going to go over that in just a second. But before I go over that, I want to ask you if you have any questions yet about, the kind of the basics of gain or loss.
No, I think that was pretty clear. And then I was going to ask you about basis. And I remember you sharing with me for my personal situation regarding basis and how, so does that include closing costs and everything when you purchase a property, that's your basis?
It may include certain closing costs. Certain closing costs are going to be deductible in the year you actually purchase, but then there are some expenses that can actually be added to your basis when you first purchase the property. So let me talk first about how the three different ways that somebody can establish their basis. So the original tax basis really depends on the way that you acquire the property. So, of course, most people, when they have real estate, they acquire it by purchasing it. So if you purchase your real estate, the original basis is going to be the purchase price of your home. But of course, people come into real estate in different ways other than purchasing it, right? So sometimes people receive it as a gift. You see this a lot when, there's a parent who wants to pass something down to their child. So if they pass it down to the child when they're alive, what happens is the parent's basis becomes the child's basis. So it's something called the carryover basis. However, if you have a parent who actually holds on to real estate until the time that they pass away, the beneficiary receives the real estate at something called the stepped up basis, which is the fair market value as of the date that the person passed away. So this is an enormous tax break for some people who acquire it through inheritance. So yeah, that's another way to establish basis at the very beginning.
Hey, Brad.
Yes.
We were talking about step up in basis and original price. Can we give some specific examples? For example, if, in that situation, let's say that 30 years ago, they bought a home in Kaimuki for $150,000.
Mm-hmm, mm-hmm.
And then now let's say the market value, just for ease of calculation, is $1 million.
Okay.
So in that example, can you tell us, how that step up in basis and how the tax would work in that situation?
Oh yeah, sure. And this is something that I think people who aren't really around real estate tax and inheritances and things like this, they're kind of shocked when they hear this because it's an amazing tax break. But let's use your example, the Kaimuki home purchased 30 years ago for $150,000 and now selling for $1 million. And you know what? We see situations, Will and Leonie, I'm sure, have seen this as well. You see situations like this happen all the time. But when situations like this happen, let's just say a parent owned that property, bought it for $150,000 and then passed away while owning it still yet. And then the beneficiaries received that property at what's called the stepped-up basis. I talked a little bit earlier about the stepped-up basis means that the basis is now the fair market value as of the date that the parent passed away. So we've seen situations like this where a child inherits property. Let's just say the stepped-up value is now considerably more than what the parent paid. The child inherits the property, sells it shortly after they inherit it, and pays zero tax at all, no inheritance tax, because it's under the $11 million, $12 million threshold. And because it's stepped up, the basis has stepped up for the beneficiary. The beneficiary doesn't pay any taxes on it either because there's no gain. In fact, it's frequent that the beneficiary receives the property, and actually, once they sell it, they actually have a tax loss. And that tax loss can benefit them in other ways in other areas of their tax. So there are so many advantages of holding real estate, especially for somebody who's looking to pass on assets to their children.
Just another reason to purchase real estate.
Exactly.
Right? Yeah, that makes a lot of sense.
Yep. So, so now that we've kind of covered like the basis of tax basis and kind of the foundation of, gains or losses, it's important to understand that there are even more tax breaks. And this is something I'm going to talk about because it actually benefits not only investors, but actually people who buy a home to actually live in. And that benefit is one of the largest benefits, that there is in the tax code right now, called the main home gain exclusion, also known as Section 121. And my graphic shows the rule is actually fairly simple. And the rule says this: a property seller may have up to $250,000 exempt, or up to $500,000 if they're married and they file jointly, if in the 5-year window ending on the date of sale, they own the home for at least 2 years, they lived in the home as their main home for at least 2 years, and on the date of sale, they could not have used this gain exclusion on the sale of any other home within the prior 2 years. So in theory, somebody could be waiving $250,000 or $500,000 if they're married every 2 years, buying and selling every 2 years and doing that, and wouldn't have to pay a penny of taxes. And so, the main home gain exclusion is one of the largest, the biggest benefit, for people who own real estate in the United States.
Hey, Brad, so in this situation, so let's say that someone moved to Hawaii, they bought a home, they lived in it for the first 2 years.
Yes.
The next 3 years, they're renting it out as an investment property.
Okay.
They're back to the mainland, and now they're selling it.
Okay, so now that they're selling it, they're at a critical time because there's a 5-year look back window, right? So you look back 5 years. Their usage, they might have used it for a while back, but that time, as you go on in time, that time that they use it as their main home is going further back in time, right? So if at that 3-year point they haven't sold by then the very next day, those 2 years becomes 1 year and 364 days. And unfortunately, when you're under the 2 years, even by a day, you get zero gain exclusion. So what happens is if somebody rents it out for let's say they live in it as their main home for a certain amount of time, and they exceed the 2 years and they get this gain exclusion that is very, very valuable. But then instead of selling it at that point, they decided to rent it for a few years. You can probably rent it 1-2 years, but if you're not actively trying to sell it by the end of the or to get it sold by the end of the 3rd year, what happens is you could have been out of the home long enough that main home gain exclusion completely disappears. And we run into situations like this from time to time. It happens quite a bit with military service members who purchase a house and they live in it while they're stationed here. But then, after being here for a couple of years, they get stationed somewhere else. And rather than selling the house, they turn it into a rental. But what happens is if they rent it for too long, more than that 3-year period, they might end up having a situation where they could end up watching that gain exclusion just kind of disappear off the map. So it's something to really be aware of. And make sure that you take steps to get the home sold if your gain exclusion is about to run out.
So you really got to track that on your calendar as a whole.
Yeah, it's super important because a lot of tax rules have like a ramp down. In other words, as time goes on, your benefit gets less and less and less. But this is something called a cliff. I guess CPAs kind of refer to it as a cliff provision. So in other words, one day you have this $500,000 or $250,000 gain exclusion. And then the very next day, it could be possible that it could completely disappear on you. So it's one of those things. It's not really a cliff provision. I mean, it's a cliff provision in the sense that you have it, and then the next day it could be gone. So you really have to be aware of when that benefit is going to expire, and that you take advantage of it, before it expires.
That makes sense.
Okay, Brad. So, well, let's unpack this a little bit, because I mean, this is a lot of information, wealth of information, and I think it's just useful, not just for investors and second homeowners, but also for principal residents who just own their primary home.
Yes.
So in terms of the tax rates again, can you just remind us in terms of for when you sell real estate, the federal is what's the percent for federal?
Oh yeah, let's only talk long term, because most people own real estate for over a year. So if we're talking long term capital gains tax rates for the federal side, that's for the IRS, your federal 1040. The most that you could pay for capital gains, the highest rate is 20%. There is something called a net investment income tax that could be potentially tagged on. It's an additional 3.8%, but the capital gains tax rate itself for the federal maxes out at 20%. For the state of Hawaii, long-term capital gains tax maxes out at 7.25%. So, in general, the state rates tend to be about a third of the federal rates, but both those rates are considerably less than the ordinary income tax rates, which is 11% maximum for state and 37% maximum for federal. So, it's one of the benefits of owning an asset like real estate is that when you sell it, you pay capital gains tax rather than ordinary income.
I see. Okay, so for the primary residents or people who own their principal residence, the tax break is at $250 for individuals and $500 if you're married.
Yeah,
so
and you know what? That's a great point, and I have some slides that talk a little bit about that.
Always on point.
Yeah, so let me show you. I got 3 slides that show 3 examples of the Section 121, the main home gain exclusion, kind of in action. So let's take a look at this. In this example, we have somebody with a net selling price on their house of $450,000, but their adjusted basis is $300,000. So it's a difference of $150,000. In this case, the $150,000 is less than the $250,000 gain exclusion that they'd be entitled to. So in this case, because the gain is less, their sale is going to occur tax-free. So both for state of Hawaii and for federal purpose, no tax at all. But let's look at a different situation on the next slide that I have. The next slide shows a situation where you have, and we were seeing this a lot in 2022, where because of the prices that just went through the roof, sometimes you have a gain exclusion that exceeds. A gain that exceeds the amount of gain exclusion. So in this example here, let's just assume we have a $700,000 sales price, a net sales price, and a $300,000 adjusted basis. So total gain in this example is going to be somewhere around $400,000. Remember, the main home gain exclusion covers the first $250,000. So anything above and beyond that is going to be taxed. So the first $250,000 for that particular homeowner is not going to be taxable, whereas the last $150,000 is going to be taxable. So yeah, you have a situation where if you go above that gain exclusion, you will be taxed on that. So that's one thing to be aware of. Good problem to have, though, right?
Hey, Brad.
Yes.
Brad, so in that example where you're selling the property for $700,000, and if you could put up the slide again, in the adjusted basis of $300,000, can you explain to your viewers, can you explain how you get the adjusted basis again? So we know this is the sales price, we're selling for $700,000.
Yes.
How do you get the $300,000?
Once again, let's assume then that the $300,000 was what the person purchased the property for. Let's say they bought it all expenses considered. $300,000 is their adjusted basis.
Okay.
So in this example, it's what they purchased for the property. That's their adjusted basis. Keep in mind that if this is your main home, you live in the home, there are certain things you can add to your basis too. Like you put improvements on your home, substantial improvements that adds to your basis, which potentially lowers your tax that you have to pay in the very end. So important for tax or homeowners to actually keep a copy of invoices for improvements that you make to your house.
And the easiest way to get exempt in that example, if you were single, it's like, okay, you know what? I'm gonna get married.
Hey, yeah.
Purposes.
You know, it's funny. Yeah, you know, for tax purposes, it does make a difference because if you do get married, and you file jointly, and you know what, this is the funny thing about that gain exclusion. You know, I talked about 250,000 for single individual and 500,000 gain exclusion for a married couple. However, not both spouses do not necessarily need to be on title. Both spouses do need to have lived there for at least 2 years, and neither spouse could have used that gain exclusion within the prior 2 years. But both spouses don't necessarily have to be on title if they file jointly. And so that's one thing. You know, one of the questions I used to get asked a lot is, you know, I'm thinking about selling my house in a few years. Should I put my spouse on title so we can get the 500,000 gain exclusion? And I usually tell people, as long as you remain married and you continue to file jointly, and your spouse lives there for 2 years, like you have, you're fine. You don't need to worry about putting them on title.
Do you have to show proof that they live there? Like, how do you prove that?
Oh, yeah. Oh, you know, here's the thing is, there are 2 times when you actually need to show proof. One of them is if you're trying to get like a HARPTA a waiver. If you're trying to get a HARPTA waiver, then you got to show proof of occupancy. Second way would be is if you get audited. Is it, you know, normally nothing gets questioned on your tax return unless you get audited, right? I mean, the assumption is everything that you've said on your tax return is accurate. So, but if you get audited, then all of a sudden the questions start to come. So, yeah, if you get questioned and the auditor has reason to suspect and wants you to actually prove that you occupied the home for a certain amount of time, then at that point you have no choice but to do so or get that gain exclusion either reduced or taken away. And unfortunately, I've worked with clients who are in that situation, and it's you know, when you take away that gain exclusion, it can be very, very costly for some people.
I can imagine. And then regarding tracking the improvements, I mean, is that like where you would just make sure to keep good records, like keep all of your invoices and all of that?
Yes. Well, one thing to keep in mind is for the improvements that you put into your property, yes, invoices are really important because they describe exactly what it is that you purchase. But also, and this is something that some people overlook, you also need to provide proof of payment. So it's one thing to have invoices, but it should be also something that you attach maybe a copy of the canceled check to the invoice as well, or, you know, a credit card kind of statement that shows that you actually paid that invoice, because you need to show what it is that you purchased and that you actually paid for it. And so that helps.
That makes sense. And that's such a good tip.
Yeah. Oh, it's a super good tip. And it's one of those tips that it's, you know, when you have to tell people in retrospect and they haven't been doing it, it's kind of heartbreaking to tell them, well, you know, if you get audited then and you know, you can't produce that, you know, the auditor could very well just take away that benefit from you.
Hey, Brad,
Yes.
know, you used the word depreciation. And how does that work in, you know, when you go to your CPA tax professional and you're working your capital gains taxes? How does depreciation come into play?
Oh, that's a you know what, that's a great question. Well, thanks for that question. Depreciation is a really tricky area of tax, especially real estate tax. One of the things about depreciation is to keep in mind is for your principal residence, while you are living in your principal residence, generally speaking, you don't depreciate it at all. It's considered to be personal use, and depreciation is an expense. You know, you don't depreciate it because it's not a business property. However, if you turn the home into a rental, for example, you know, the depreciation is, I guess you could kind of view it as a systematic way of recognizing the expense that you have incurred for purchasing this property and using it in real estate over time, right? The benefits that you get from real estate are going to incur over a long period of time. So it's a lot of times they don't allow the taxpayer to get all the benefit of the entire expense in the year that they purchase. Depreciation actually for a rental home occurs over 27 and a half years. That's the IRS standard. That's what you use. So the depreciation occurs on the building only, not on the land. The land is considered to be, remaining stable or increasing in value, whereas the building itself, buildings are, get used and deteriorate. So you expense those over time.
And that 27 and a half is for single family or for condo and townhome. It doesn't matter. That's the number.
Yeah, that's correct. Single family or, townhome. There is a different depreciation schedule for commercial property. If for commercial property, like, office rental, for example, if you had something like that, that gets depreciated over 39 years. But residential real property, the home that somebody rents to live in, that's 27 and a half.
Always learning something new. So basically, it's a tax deduction for investment properties.
Yeah,
for your principal residence.
It is. It is a tax deduction, but one thing to always be a little bit cognizant of, and this is something that's really important, right? Kind of built into the whole premise of depreciation is this idea that your asset that you have is depreciating in value over time, which is the reason why you're allowed to declare expenses, a deduction, like you said, Will. However, when you sell property for a gain, which happens for most people who are selling rental real property, you sell for a gain. What happens is, because you're selling for a gain, that premise that you had that your value was decreasing over time, it's not true. So what happens is, if you are depreciating your property and then you sell for a gain, there's something called depreciation recapture. And depreciation recapture is a way to kind of penalize you, so to speak, for the depreciation that you took in the earlier years, but you didn't really need to because it wasn't, your asset wasn't decreasing in value. So, depreciation recapture is an entire 30-minute segment itself. So we'll go over that maybe the next time you have me on. I'll talk about depreciation recapture, and then, people can learn a little bit about that.
Depreciation recapture doesn't sound like something I would like.
Oh, yeah.
Just kidding. It's good to know. No, yeah.
It's good to know, but I guarantee you that if you have people watching this show and I'm talking about depreciation recapture, there will be a lot of really sleepy people at the very end of the half hour. So it's
impossible.
Not exactly the most interesting topic, but I could try to make it interesting.
You always do. You always make it interesting.
Thank you.
And is there any final message that you would like to share? And how would people reach you, Brad?
Oh, okay. Well, I work in a very specialized area of tax called HARPTA. HARPTA and FERPTA are withholdings that are done on Hawaii non-residents or foreign persons when they sell, real estate, usually in Hawaii. Our clients are own Hawaii real estate. So that's the area that I practice in. If you want to learn about what I do, HARPTA.com is our website, HARPTA.com. And you can learn about how we help people get waivers, reductions. We've gotten over $20 million in waivers and reductions over the last 3 years for our clients. And so this is an area of business that we specialize in and we love doing.
Well, thank you for helping all of the people with their HARPTA and FERPTA situations.
Thank you.
And oh my God, we're so grateful to you, Brad, for being on our show, Inside Hawaii Real Estate. And we just appreciate you so much.
Well, thanks for having me on. I always enjoy talking about this kind of stuff. Most of the people in my life, they don't want to hear this stuff. You guys are one of the few people who actually are interested in hearing me talk. So I'm so grateful to have you on, that you're happy to have me on your show.
We love having you on the show. This is, second time, and definitely want to invite you back in the future. So thank you so much, Brad.
Thank you so much, Brad.
Oh, thanks. You take care, guys.
Aloha.
Aloha.
Okay. Bye-bye.
Thank you so much for watching ThinkTech Hawaii. If you like what we do, please like us and click the subscribe button on YouTube and the follow button on Vimeo. You can also follow us on Facebook, Instagram, and LinkedIn, and donate to us at thinktechhawaii.com. Mahalo.